Yo, what's going on, guys? It's Gray here. Welcome back to another video. And in today's video, we're going to be talking about the #1 wealth killer of this generation. What's sad about it is I feel like everyone, at least in your younger years, we're just kind of told that this is how it has to be. Because, 10, 20, 30 years ago, it might have been possible to get a car for a few $1,000s. Now we're just told 30K, 40K is just what you have to spend on a vehicle. And while I understand why people feel that way, I don't think that's actually the case. And so I wanted to look at today, because it's the #1 wealth killer in my opinion, I want to talk about the cost of actually financing a vehicle. And I want to speak to this both because I'm actually in the market of looking for a car right now, and also because there might be instances where you need to finance a car, but the way people are going about it is not smart. So I want to say that before I start this whole video, I'm not saying to never finance a car and that it's never a decent option. What I am saying is that if you're gonna finance a car, you need to do it in a very intelligent and considerate way. I want you to be conscious of how your money is being spent, and sometimes there is a price to pay for not paying in cash. So while I do think that's okay, we do need to be considerate of it. So let's go ahead and hop into the video. I have the camera set up a little bit differently, and by the way, I really love how this looks. Lauren is very good at designing all of these, but in these specific videos, I am gonna try to put some of the numbers that I talk about actually on the screen so that you can actually see the numbers that I'm talking about. When you are financing a car, all that means is that whatever you're actually paying for the car is going to be spread out into monthly payments, spread out over a specific period of time. So, for example, I will say that the average car payment in America, I'll read it real quick. In the first quarter of 2024, the average monthly car payment for new vehicles was $735, as high on the average of $756 in June. About $700 to $750 a month as a car payment. That number, it baffles me, because if you just invest that, then I'll talk about that. If you invest the difference, it can drastically change your financial life. But I just wanted to throw those in there. The fact that the average car payment for a new car is $735, give or take. There's a few terms. There's going to be the term length, so how long they're actually going to be paying that. The price of the car that they're getting, the fact that they're spending way too much on their vehicle, and they extend the term length out so far that that's the only way they can actually afford to get these vehicles. And the other thing is the interest rate. So it used to be, 3%. Now we're looking closer to 11, 10%. I remember I filled out some things, and with my credit in my area at specific dealerships, if I was to finance a car, it would be about 9% interest, which is just, it baffles me. And with that being said, you can only really get about 7 to 12% in the market. So if with my credit we're looking at 9 or 10%, that means if you have poor credit or bad credit, it's going to be closer to 12 to 15%. And I've seen as high as in the 20s when it comes to actual car financing. So before I lay out all the numbers, the opportunity cost of the car payments, the fact that you are having to spend $700+ a month as a car payment, which, the fact that you're having to do that means you're taking away money from saving and investing, and it's going to be like that for years. And so when we get to the end of the video and I talk about the actual rule that you can follow to finance a car, that is something you need to remember, is the fact that with all these averages and all these numbers, people are spending huge percentages of their income on transportation, which is baffling. So now let's get to the numbers. This is my favorite part of making these videos. And if you know me, you know that I am a math person. I really do enjoy the number side of things. And this is how I critically think about what I'm spending my money on, is by doing the actual math. And so I just want to lay out a few examples and input your numbers as you kind of want. And honestly, if you want to use ChatGPT, it's super easy. You can just type in the numbers and how it all ends up, and it'll do the math for you. Let's look at a scenario. So scenario, imagine investing $700 a month instead of the car payment. So for this math example, if you invest $700 a month with 30 years with an average annual return of 7%, which is, the typical amount for a good diversified portfolio, that's a very conservative estimate. With that, you could accumulate approximately $1.6 million. And that is just with 30 years. For me, at least, that would put me at 51 years old. If you let it keep going, it could, go up to 2 million, 3 million, given more time. So especially with these younger people doing like 18 to 25-year-olds, where we're financing cars that we really can't afford with a payment that really doesn't make sense, if you invest the difference, you could have literally millions of dollars. We'll kind of come back to that in a second, but I do want to touch on the depreciation of this. So you're spending $700 a month instead of investing or anything like that, and you're spending $700 a month on a depreciating asset, which historically loses about 20% of its value in the first year and then 60% of its value over the subsequent 5 years. In my head, if I'm gonna buy something that is gonna go down in value, I wanna spend the minimum amount that I can. And I'm not saying that I will never buy, a super nice car or anything like that. I do think that the car that you own should be a reflection of your income. Again, we're almost there. I'll touch on that at the end of the video. With that, if you're gonna buy a vehicle, know that if you're gonna buy new, it's gonna be depreciating very quickly, which is why typically in the finance world, we recommend getting used cars, because it just makes more sense. If you're gonna spend money on a depreciating asset, be the one to get the benefit and not take the hit of losing all that value. So if you have a $30,000 car, brand new, if you waited 5 years or just got a 5-year-old older model, 5 or 6-year-old older model, you could save yourself the big depreciation. So this is my favorite part, the financial impact over time. So let's look at this. So I put a lot of these numbers in ChatGPT, but you can specifically put them into your specific situation. But let's say that you have a $30,000 car financed over 5 years at a 10% interest rate that ends up costing you about $34,035, which includes $4,035 in interest. Kind of. A lot of these math and a lot of the statistics is just simplified compound interest and all of that. But what it doesn't consider is the fact that this is over a 60-month term. And I will quote this, the average auto loan interest rate for new cars in the second quarter of 2024 was 6.84% to 12.01% for used cars. So that's including, where you're living, how much you have down, things like that. It can really depend on what your interest rate is going to get, as well as your credit can really impact that. So as I said earlier in this video, for me, I got a 10% rate, which definitely helped. It is definitely lower than other people that I know have gone to this dealership and gotten a rate, but in the grand scheme of rates, I don't want a 10% because that 10% I can't make up in the market. My savings account gets 4.5%, and any of my investment accounts, and though they're up right now at about 12.2%, it's not sustainable. It's going to average out to be about 10%, where I'm actually probably going to end up losing money financing a car. So with some of these numbers, we do want to consider a few things. There is a long-term effect to spending this, because if you're going to be in a car for 3 to 5 years, hopefully longer, you're going to end up having to spend some money on it, both in maintenance and gas and things like that, repairs, normal things like that. What you don't want is to be in a car that is sucking money. You should and could be investing and saving the difference. It honestly feels like a shame to me to work so hard for your money just to lose it all in a vehicle. Now that we're near the end of the video, there are two options that I propose. The first one is pay cash. Now, this is going to be hard. This is going to be a challenge. Obviously, if we're building up an emergency fund of 3 to 6 months of expenses, after that, you're going to need to start saving for a car, regardless of if your car is brand new or anything like that. I genuinely think it should be a line item, and everybody's budget is setting money aside for a new vehicle. And I don't mean new like it's a brand new car, but just a vehicle that's new to you when the time does inevitably come, because very rarely in my experience can you actually plan for something like that. And then I would say, when you're paying cash, check Facebook Marketplace. I will say be very careful, and I have thought about making a video on this. Be very careful. There are a lot of scams. People switch VIN numbers, people switch parts, people switch plates. There's a lot of stuff to consider on Facebook Marketplace. So if you can buy from somebody that helps. Get it certified by an actual mechanic that you trust. That definitely helps. But if you're going to buy from a dealership, buy what you can afford. $10,000 can get you a somewhat reliable car. And if you want to spend more than that, you can, as long as you're paying in cash. And then I will say the second option, as I said in the beginning of this video, I am fine with financing in specific options. And one of those is a rule that the Money Guy Show came up with. So what is the rule? It is the 23-8 rule. So with that, 20% down. So whatever the value of the car, we'll use basic examples. If the car is $10,000, 20% down would be $2,000. And then 3, meaning no more than 3 years of a term length. So that's 36 months. And then you're gonna have 8% or less of your take-home pay after taxes and after everything. 8% can go towards that car payment. This keeps you in the safe zone, where if you're keeping your needs below 50% and you keep your car payment in those needs at 8%, you're still gonna have enough left over where you can actually comfortably afford the payment, and you can comfortably afford to make extra payments to pay it off earlier, which is also a part of this equation. Is I wouldn't just make minimum payments, especially at the interest rate that I was offered at 10% and the interest rates that are offered to people now between 6 and 12%. In my opinion, it makes more sense to just pay off the car as soon as humanly possible. So making 2 or 3 extra payments is possible if the payment is below 8%, because then it's 16 or 24% of your take-home pay. It is fiscally possible to actually afford it. Again, no hate to anyone that finances a car, and this is just some guy on the internet doing some math, but that is my opinion on the #1 wealth killer in America, is when people finance cars they can't afford. Anyway, guys, I really hope that you take this video, one, with a grain of salt. Again, I'm just a guy on the internet, but also if you do like it, take it to heart. Focus on building the life that you want by investing and saving and building wealth for you and your family. So thank you all so much for watching today's episode. If you guys have enjoyed, drop a like and comment down below what I should talk about next. And what do you think is the biggest wealth killer here in America? Let me know in the comments. Anyway, thank you all so much for watching. I'll see you all in the next one. Adios.